Good morning and good afternoon to you, Daniel, and thank you for joining us today. My name is David Talbot, Managing Director and Head of Research here at Red Cloud Securities. I'm delighted to host another Red Cloud webinar on uranium today. We are going to hear from GoviEx Uranium Management, including Daniel Major, the CEO, where he will discuss today's positive Midwela feasibility study. Now, during today's webinar, he will provide an overview and outlook. He will then take some questions. You can type your questions into the chat box at any time. We'll get to as many as we can. Before we kick things off, we need to first discuss the fine print. During this GoviEx webinar, forward-looking statements may be made. I would like to direct listeners to the forward-looking statements outlined on page 2 of the company's website, goviex.com. For Red Cloud Securities, I'd highlight this webinar is for information purposes only. It is not considered a recommendation or it should not be considered a recommendation or solicitation to buy or sell securities. We note this call does not consider the particular needs or situation of individual investors. Participants should rely on their own investigation and seek their own professional advice before investing. Please see our most recent research on the Red Cloud website for specific disclosures on GoviEx Uranium. Now, with that, I turn it over to Daniel to update the audience on GoviEx Uranium and today's feasibility study.
David, thank you very much, and appreciate you and under short notice organizing this webinar for us. As you know, we've been working on the Madawela feasibility since February of last year, when we completed the pre-feasibility study and announced that. The program has consisted of a substantial drilling program on the Miriam deposit, the open pit. We've done a full rework on the environmental impacts on the project. We've taken substantial metallurgical samples out to South Africa to do a full pilot test work. And then gone back and got absolutely everything re-engineered, re-quoted, and redesigned. So hopefully we'll give you a full context of all of that. And in underlying that, we are very positive and very happy with the result we've achieved, particularly how the market has moved since February. We've been through some major shifts in pricing structure, in inflation in general, and we've had to deal with that. At the same time, obviously, we've seen a much more positive timing out there and overview for the uranium market itself. So just some background, just to kind of put us into context. You know, we are a development-focused company. We have the board, the management for that. Just highlight here for Madawela and Matanga that they're both fully mine permitted. We do have the exploration play at Falea. Strengthening uranium market, very much where we're going to on this. We've seen a lot of that with regarding the European markets, increasing focus on wanting to build reactors. We've had news from Japan, South Korea, all turning around decisions and going forward. The timing advantage here is very much about getting this into production. Our target remains very much on 2025, subject to securing the financing. Africa brings these advantages, being able to get these projects permitted and move forward. And we have a very large mineral resource here and within the company as a whole. Africa continues to be our focus. And that's really plays through here as well, because we've been able to use these benefits on the project as a result that it is our mining jurisdictions, and this particularly at Madawela is a mining jurisdiction. So really from the highlights of the project, and I'll obviously stick to what's in the press release and I'll try and give some color around that. But what we have done here is ensure that the FS is based on a fully sustainable operation. It includes the costing of the full mining operations, the full process plant, and the full cost of the renewable power on here. So we are not reliant on any third parties' facilities. This provides us some opportunities going forward, and I'll revert to those later. We are looking at a net present value of $140 million with an IRR of 13.3%. Compared to the previous projects, the life of mine stays consistent. we are looking at close to 51 million pounds of uranium being produced at about 2.7 million pounds per annum over 19 years. The test work is underpinned, and we'll come to that later, but life of mine at 92.2% on uranium, 80.7% on moly. I think one of the keys to this project is our ability to contain the capital and actually, like for like, reduce the capital over what we've had in our previous studies. So well underpinned by a long-term cash flow with a very solid average EBITDA of close to $83 million per annum over the life of the mine. Benefits. Clearly, we are benefiting here from this project from being close to these operations of Cominac and Somaïr. The infrastructure is there. We've got good power, good roads, good water. The project continues to focus on how we can limit the consumption of water. But one thing that's clear by all of the additional hydromet work that we've done is water is not a concern from a supply point of view, more from our point of view of, what can we do to reduce the extent of what we use. We are permitted in all aspects and ready to move to the next stage. Summary of the mineral resource, it's pretty well unchanged. There is a small reduction on the Miriam resource, but we've got an increase on the M&M resource coming through. We have taken one deposit out of here. That is the Labanan deposit that was previously in our mineral resource. That's because we gave it back under a license. It was over 300 meters deep. We didn't really see that to be a big issue. So really focus. The MSCE deposits and MSEE deposits are not part of the feasibility study at this time, but present an opportunity. We did update the molybdenum. We have drilled both in the open pit and the underground. The underground still needs more coverage, but very pleasing to see the strong grades coming through in the areas that we have done. In Miriam, disappointed really from the molybdenum grades that came through there, and that has had an effect on the project. Just to summarize the overall structure, very similar to what we've had before. So we start in the south with a process plant next to the Miriam deposit. We build the tailings dam there. That tailings dam is now being designed to be continuously rehabbed as well. It helps reduce the amount of dust in the environment. It is a dusty environment, but we still want to make sure we're fulfilling our ESG requirements here. We have a very large well field, so plenty of water. In fact, when we get to the underground mines, we have to start putting re-injection wells in and start putting water back into the ground because we're getting so much water from underground. So water's not a problem. As I said, we brought in a solar farm here. We're looking at about 8 megs of solar with a battery. That results in about just under 30% of our total energy being consumed on site, planned to be renewable. It means that we can get a steady supply of power. The grid is only available about 70% of the time. This meets those needs and reduces the overall power cost of the plant. It also means that as we are at the end of the power line, we are never at any hostage to power supply. We will continue to be able to supply our own power to the plant. We have maintained a focus on international standards all the way through in the design of the project. Engineering design sitting on the plant side. We have basically maintained the same plant design that we had before. So it's a crush mill, acid leach, ion exchange, then get a moly product and get a uranium U3O8 product. The only real changes have been partial designs. We've taken out the SAG mill and put in a Vero Liberator mill. There's some images here. These are very small, but they can easily handle over 100 tons an hour, which is what we need. They're very low cost, particularly from a power point of view. They substantially reduce our peak power demand because they don't need any restart power, unlike a normal SAG mill. And they're very easy to maintain. So they've gone in. We've taken out the normal cartridge ion exchange and put in continuous ion exchange to make it a lot easier and lower OPEX. You will note here there's a difference between the open pit and underground from a recovery perspective. That is because when we come from the underground, we have a higher dilution. We've put in radiometric sorting for that to strip out the hanging wall above the ore body. And then we do reverse flotation of that to strip off the acid consuming calcium products so that we can bring the acid consumption down in line with the open pit, very low one that we have from the open pit. If you look at the capital, as I said, very satisfied here that we actually have brought it in under what we had before and have added the additional cost of bringing in a full solar hybrid. Over the life of the mine, sustaining capital is down by a lot. We were looking at 301 million. We're down over 10% on that design. That's predominantly on the back of re-engineering. And again, that includes an extra solar farm as well for the underground. So again, ability to re-engineer our project, reduce costs. If we look at our operating costs, the key, if we look at mining costs, they're actually down. We are looking at SG&A costs that are down. The area that we have been impacted in negatively is our processing costs, which have actually gone up. They've gone from about $10 a pound to $13 a pound. That is almost predominantly on the back of hydrocarbon-related reagents, particularly things like sulfur, which since February of last year have gone up over 63%. In fact, we can actually find higher quotes if we want to look for them. But yeah, that has been a big issue. So we're looking for an all-in cost, a cost without the royalties and the moly credit coming in at 28. I think we were looking at 25 before. So there has been a net impact coming through. We do start with the open pit, as you can see from this table, much lower operating costs in the open pit from the top than we get from the underground. So that underpins the startup of the project. Net present values, providing you here, we provided them with just the mineral reserve and without and with the additional moly resources that are available, but not being put into the measured and indicated category. So a lot of leverage here on this project. We have moly in all of our test work from underground, so we know it's across the whole deposit. The other optimizations that are not in here, one is certainly to go back now into the next stage on the engineering design when we get to the detail and strip out potentially the cost of the solar farm and go for a PPA. We felt it was better and more conservative to leave it in at this stage. On the mining side, we've costed for brand new mining equipment, but certainly in our studies, we found there was a lot of potential to go to secondhand mining equipment, make substantial savings there. And actually, another part of the design that's not included yet because we took the conservative view is the ability to access underground operations from the base of the Miriam open pit, which would allow us access to a number of the other deposits that are there but are not included in the feasibility study. And that would allow us to get lower capital in the spread between the projects. So we've left those for now. We're very happy with where we've got. We've taken a solid commitment on the ESG here. We have sought to reduce our carbon emissions. We've made sure that we've taken into account all of the concerns that were out there on dust, on water consumption. We have focused on a 100% local labor force and local procurement. And we're focusing on design, on our training for diversification on the project as well. And hopefully, we're planning on putting out in the next month our first ESG report just to underpin that. So very much, everything that we're trying to do strategically, I think we've underpinned in this project design and looking forward to going to the next stage, which is now working with Endeavour Financial on the debt side and certainly working with Chris Lewis, our marketing guy, to extend all of the conversations we've already been having with the off-takers. So this has already been sent out to all the off-takers we talk to, and we'll see most of them at the NEI conference in the middle of October, and we'll continue our discussions there. So, David, thank you very much for giving me an opportunity to go through it, and happy to listen to your questions.
Great. Thank you very much, Daniel. Great presentation, very succinct. So we will now start the Q&A portion of the webinar. And so far, we've got a few questions here. Congratulations, first of all, on the feasibility study for Meduela. I guess before we get into the nuts and bolts of it, could you give us some a sense of how big this project really is. The large resource, long life potential.
Yeah, as I say, I mean, it's 19 years of life, producing about just under 2.7 million pounds per annum. We actually stopped exploring at Madahuela back in 2010 and just did the infill drilling, and that was really our focus, was to kind of unleverage this. The focus now can be really to expand on this. We see this as the starter, and then we can explore around it to get bigger. So we've got 3 more licenses. We abut the Cominac deposit. There's a gap between us and Cominac, which we have the license in for. So yeah, there's plenty of potential here, but it's get the right scalar project going, and then scale it up once it's built.
Mm-hmm. Do you see the need to return to exploration here at all to extend life of mine in the short term, now that you've got the development, and how much of the project?
I mean, there is an option to go onto the Madahuela 4 license to go and do more work on a very much a Miriam style target that's sitting down there. So we will go and have a look at that. If that comes through, then obviously that will extend the open pit potential and improve the economics, and defer the need to go underground.
Okay, great. Thank you. The project is largely permitted as well. Can you tell us what else is needed from a regulatory standpoint?
Yeah, the only things we need is we need to get approval from the local mayor to be allowed to use the area of ground, which is fairly perfunctory. And then we just have to work with the water authority on access to water. But other than that, nothing of major import.
Mm-hmm. And the project's already set up with 20% owned by the government of Niger, including a 10% freed interest, 10% active interest. What does that mean for Niger?
Niger, effectively, we finance the project and we recover the loans first. They're sitting with about a 7% royalty on this, so they get that, and then they get the corporate taxes. So overall, I think they get about $500 million is the bottom line number.
Okay. And you have built this project to be self-sustaining. You've got the plant on site, you've got grid power, solar power coming in, acid plant, local workforce. Can you explain why these are so important?
Yeah, I mean, look, there is a grid there. It's a coal-fired power station grid. It's got 2 turbines that go down 1 month each a year. They stretch a very long way through the middle of the desert. Where if we're going to spend this much capital, we want to make sure it operates all of the time. So that is key. I think just generally as well, globally, mining companies are trying to do the right thing from an ESG perspective. So that was very much part of where we're trying to go as well. But it also pragmatically reduces our overall grid power costs as well. So those are all key aspects of kind of why we've done that. I also need, we have a plant design here. We have molybdenum, which makes it quite difficult to go into the Orano mines with our process. They're full anyway, the one at Somaia. So again, it was to make sure that, this project hangs together as a proper project. There's nothing left that we haven't already covered off in our design.
Mm-hmm. Okay. And you've gone great lengths de-risking the project. Technically, through excessive pilot plant testing, you've simplified the plant flow sheet. What else can investors take away from your de-risking effort?
Yeah, I mean, that's been key to us as well, is it's just to kind of remove risk. We've also done it at the front of the mine. We changed the pre-strip. So previously it was taking us 2 years to pre-strip, and now it takes us 9 months. By turning the project around. That means there's less risk of that part of the schedule falling behind and the plant getting built without access to feed. So that was a key part to it. We've made sure that all of the components can be delivered well within the time frame. I mean, the industry globally is suffering on things like SAG mills taking time to get delivered. So that's another area that we were very much targeting on. As I say, we did a lot more work on water to make sure we understood our supply of water and our ability to constrain it. We've also tried to kind of reduce the overall water output. So we have a bleed stream. Every mine has a bleed stream into its tailings dam. We've done a lot of water test work on that. We're actually going to use that for our dust suppression because it's clean enough to be used for that way, but it stops us using fresh water for dust suppression. So it's things like this. We've gone through and dealt with it. We've also built in a full allowance for training right into here. So while there are people from Cominac and Somea that I keep getting CVs for, we want to be able to access and diversify the workforce as well. So we've built in a full training program and training budget here as well.
Okay. Now, initial capital down slightly to $343 million, and that's on top of the new almost $20 million solar plant you guys have added. How were you able to curb rising initial and even sustaining capital costs in such an inflationary environment? And maybe could you give us a breakdown of that plant CapEx?
Yeah, I don't have the breakdown fully because it's also our infrastructure in there. So, I mean, I can't break it down to you at the moment in sort of each component part. It's a little more complex but the total plant was 209 and has stayed pretty well flat at 209. The difference in the processing cost is that historically we put our infrastructure separately. Infrastructure is now built, the SGS now do it, so it's covered in there. So overall, the plant is about 210. The infrastructure, which is all of mine buildings, the explosives, all of that stuff goes in there. It's about $30 million. The infrastructure now is the power plant, all the grid connection stuff. So there's about 20 million in there for the solar. We do have 8 meg of diesel backup just in case everything shuts down in the middle of the night when the solar isn't around. And then there's the main power grid connection coming through. So infrastructure now is pretty well power. So that kind of splits those apart.
Yeah. And how did you skirt around this inflationary environment?
Trying to be smart, basically. I mean, things like the SAG mill, we went to the Vero because it was a lot cheaper. One of the benefits, if you go onto the Vero website, you'll see, and when we did our test work, it stands on a block of wood. That's its foundations. It doesn't vibrate while it's operating at all. Whereas if you put a SAG mill in, you have got massive foundations that have got to go in to hold it in place. So it was things like that where we were doing trade-offs and saying, well, yeah, this is new technology. We've taken additional capacity there. So we've got double the capacity on milling from the Vero to make sure even then it's cheaper than the SAG mill option. We went wider on our grind. So we did a lot of met test work to go for a coarser grind and get the same results. So it's things like this, when you work it all the way through, we took the ion exchange cartridge out and put in the continuous because it actually was cheaper at the end of the day as well. So, and we got everything tendered at least 4 times. So, it's shopping around. There's quite a range in pricing when they come in, but if you shop around, you can get the right price.
Okay. How might you look to finance your initial capital here? Are you looking at debt, equity, offtake?
Yeah, I mean,
partial asset sale?
Absolutely. I mean, we're totally open to methodology more than anything else. And you and I have had this conversation before. At the end of the day, you've got to pull the cash flow coming in, and it's got to go out somehow, paying for OPEX, and then the rest has to go and pay for everything else. At the end of the day, you're obviously going to commit to get the best price you can for the input, because that's really what the debt side is going to want to see, that you're underpinning your revenue stream, assuming you make your uranium production. Debt is going to be very much the first focus. We brought Endeavour Financial on last year to help us, and they've been very supportive in this project to work with us, with the independent engineers, to make sure everything is comfortable. So we'll be looking at, something like about 40-50% debt. That's going to be kind of where we're going to go for. We really won't know until we start that engagement with the debt market and they do their review of the model that we've got. And then that will leave the equity side to cover through. And as you know, on these things, there are multiple forms of debt that go in. At the end of the day, whether you're forward selling uranium products or whatever way you do it, streaming, which effectively the same thing, you're just eating from the same pot. So there will be a structure out there.
Right. Okay. OPEX up about 20% to $31.50 or so per pound. Yep. Do you have an all-in sustaining cost number? And is inflation really to blame here? What are the sort of cost drivers?
As I said in the presentation, if you looked at it from a mining cost, you looked at it from a SG&A, they're flat. We were able to engineer down a cost by changing the way both the open pit and the underground were going to operate. We revisited our SGA and said, look, we don't need some of these things we put in before. It's still valid. The key driver was process costs. As I said, it's almost totally reagents that have come through on us. Some reagents are in excess of 60%. We've had a small increase in acid consumption as well. But the biggest single driver is reagent costs.
Okay. Is there room for improvement in CapEx or OpEx? Items you couldn't put in the technical report, perhaps?
Well, as I said in the last slide, those are kind of some obvious things. So, if we can get negotiate a good PPA that gets us a lower LOCE, levelized cost of electricity, then yes, that power plant doesn't need to be a capital figure. On the mining side, there's no reason why we need to go and buy brand new Caterpillars. We can pick up refurbished Caterpillars, with 10,000 hours on for 30 to 50% cheaper than we've currently got in there. So that's an option to go forward as well. So yeah, there are still ways to do this, but we've obviously taken the conservative route because that's what we've got to get past the banks.
Okay.
And you asked me on if levelized costs, if you add the total capital up, which is 612 for the project, divided by the 51 million ounces that get produced, you end up with pounds, $12 a pound.
Additional.
Yeah.
Yep. Okay. The MPV, it's up about 20%. Free cash flow up 30%, but uranium price is up about 20%, your assumption as well. Does that mean you're going to need something like $65 a pound for before you hit a production decision?
Yeah, well, I mean, we'll obviously see what the debt guys will let us get away with. We put it in there because I think it underpins the project well. I mean, there is a number in there that can work lower. We'll have to sit down with the off-takers and see what we can get. The one thing I will say, talking to the off-takers at WNA, and you were there as well, certainly for a lot of the off-takers, the messaging from the suppliers is inflation is hurting. And I spoke to a couple of suppliers who asked me how the project was going. And I was saying, well, here's what's affecting me. And they go, yep, exactly the same things affecting us. The one difference they are experiencing, we are not seeing on the ground, is labor inflation is a lot higher in other jurisdictions than we're seeing it in Niger. So that's another added factor that will affect other projects. But yeah, it is consumables inflation has been hurting. We did a lot of work on logistics. That was another aspect we have to come through. I think certainly on a lot of the capital, the bids came through. Well, shipping prices were quite high. So I think there is some movement there that we can possibly get better logistics on some of the capital coming in as well.
Okay. Now, do you see Orano as being interested in acquiring projects in Niger? It's got a plant it needs to keep operational. Are there any synergies with your project? Any other?
Yeah, I mean, we're directly next door, so there is always synergies to do that. I mean, they've obviously got Somaïr still running. There is options to feed the material into Somaïr. I mean, at the moment, their grades, they high grade their ore body, and we wouldn't be able to fill that need. So we would have to go onto their heap leach, which has a very low recovery. I think their recovery on the heap leach is like 70%. So, mining it up and chucking it on their heap for 70% recovery just doesn't make economic sense. When your mining and processing costs are almost equal, you're losing too much.
Okay. Last question before we move on. I guess there's been heavy rains and flooding in Niger, might even impact some food supply chains. How long might these impact the country, and is there any impact to your operations?
No impact on our operations. I mean, we're way up. We historically and will continue to support communities in the region that have been impacted. We've done that in the past. Niger is a country that oscillates between drought and floods. And we had the same problem last year as well, and we supported a number of villages that were washed away. We spend quite a lot of money every year supporting our villages around us, not just in Niger, but in Zambia and in Mali as well. Interestingly, the government strategy has three pillars at the moment. One of them is food. They are definitely changing the way food is cropped in the country, bring a lot of new technology into there. The other one is education, and particularly the education of girls, which is one of the reasons why we've gone for diversification of our labor force much more. And then the last one is power. Niger is spending a lot of time and a lot of money trying to expand the power base, which will allow growth of the communities and the economy. So that fits very much with what we're trying to do. But yeah, we help all our communities, and food is part of that.
Great. Okay. So I guess just moving on, one final question here. You do have other projects in Africa. Perhaps give us a brief update on what else you have going on.
Yeah, so do them in order. So Mantanga, you'll notice on our slide deck, they've got a spelling change with an extra N added. That was at the request of the community who said we were kept using the colonial name. Can we have the Zambian name? So we accepted that change. So it's not a misspelling, if anyone points that out. Yeah, on that one, we are drilling at the moment, infill drilling on the Dibwe East deposit. We were pulling out core soon to go to met test work to prove up the Dibwe East. AMC consultants are doing an updated ESIA on that project for us as well. So that one, we're moving forward very successfully towards hopefully a final FS for that one at the end of next year. We'll then allow that one to trail through. In Falea, I'll be putting out a press release in the next few weeks on the drilling results from that one. We missed August. My geologist spent 6 months on site without leaving it. So I did give him the month of August off, and the results, we were 12 weeks behind on drill result assays coming in. So a bit of a drag, but we will have something out on that one very soon.
Perfect. Okay. Well, let's wrap it up there, Daniel. So thank you very much for joining us today.
Yeah, thank you very much. And we're very happy. I mean, I think we've done a fantastic job of controlling inflation here. This project is still very well underpinned. And as I said, we've gone to the extra detail. When the FS report comes out itself, it's substantial in size. I've had to read it all at least several times, and you'll find it's an incredibly detailed report. So hopefully, shows you it is a proper FS.
Excellent. Look forward to reading that. So thank you, everybody else, for tuning in. Red Cloud Securities will be back on Thursday afternoon when Taylor sits down with Heritage Mining. That's September 22nd at 2 p.m. Eastern. So have a great day, everyone. Thank you very much.